Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
In this video, we're going to talk about stock market frauds and how you can avoid them. Recently, in a newspaper article, there was a story about a software engineer from Bangalore who had lost 91 lakhs to a stock market fraud. This is not the first story, and it's clearly not going to be the last in this genre. We've seen many frauds occurred through the year, especially large value ones, and when we aggregate those numbers together, we realize that a lot of money has actually been lost to fraudsters. So, is this something that people need to learn the hard way, or is there a better way to spread the message and educate them? In this video, we are going to talk about how you can avoid them. So if you can think of somebody who would benefit from this information, do share this video with that person. So let's look at a quick handy checklist of what you should do when you're looking at investments. If you're a DIY or do-it-yourself kind of investor, then the best thing that you can do for your financial security is to work with well-reputed platforms and applications. Right? If you go through a well-established route, the likelihood of you dealing with a fraudster reduces significantly. And second, if you're working with a well-established entity, there are always redressal mechanisms, even if it takes a long time for you to get your money back. Second, if you are an advised investor, that is, if you're working with a professional, or if you get onto a course, or if you are working with somebody else who's going to help you manage your money, who's giving you tips and advice, then it's important for you to know where and how they are being regulated and to have their license numbers. So if you're working with somebody who claims to be a portfolio manager, then you should look for their SEBI registered PMS license number. If you're working with somebody who claims to be an investment advisor, then they are also registered with SEBI with an RIA number. If you're working with a distributor, then they are likely to have a distribution registration number with AMFI if it's in mutual funds. So knowing where this entity is registered, what their license is, and going and cross-verifying and seeing if they have a legitimate setup actually makes a lot of sense, especially if you're not going to meet in person. Which brings us to the third safety mechanism, which is to follow an in-person meeting. So insist on meeting this individual in person. It's not enough to be added into a WhatsApp group or into a community which is virtual, because there is no way of you knowing who else is in part of that community. If you can't arrange for an in-person meeting and this is more of a digital platform, try to assess where their physical offices are present and try to visit those offices once to give yourself a sense of security. The fourth thing that you can do if you're unable to do step 3 is to actually identify escalation protocols. Right? So if something were to go wrong, how can you recover your money? How can you raise a complaint? What are the resolution mechanisms that this entity has that will support you in a tougher period? It's all well and good to look at returns and how they perform, but you should also be prepared for the downside, because the one thing that's true about the stock market is that it doesn't always go up. Now, the fifth thing that you can do is to actually independently verify returns. So when you go through all of these stories and understand what this mechanism of this fraud is, a lot of times investors are shown abnormal returns on their platforms or their applications, which makes them participate more. But one thing that you can do as an investor, especially if you're going with an unknown platform, is to look at whether you're actually making those returns by tracking what's happening in the market instead of numbers that are shown on your screen. If you're making unbelievable returns, it's important to be a little skeptical about how you've actually gotten those returns. Which brings us to point number 6, and that is to avoid leverage. To your best ability, it's important to limit the amount of debt or leverage that you take onto your portfolio, because leverage increases the risk and can substantially increase your losses as well. So when your losses are magnified, that becomes a wealth destructor, and it's important for investors to be conscious of how much leverage they're taking and how much leverage they can afford to take, and if possible, avoid it altogether. There's an interesting Russian proverb that says, trust but verify. The idea behind this is that while you see returns that are very alluring and promising, it's important for us to verify whether this is a legitimate source of wealth creation or not. When we're careful with our money, we tend to be better wealth creators, and we wish you a successful wealth creation journey.